afternoon. Committee will come to order. And thank you for joining today's briefing entitled Failing Retirement Savers, examining 3 recent Labor Department's actions held by the Committee on Education and Labor. This briefing is a public-facing event. The recording of the audio and video will be made available to the press and public shortly after it concludes. I note that we invited our minority colleagues to the briefing, but they've declined to participate. Nevertheless, the briefing is open to all committee members, and we will continue to invite all of our colleagues to participate. This is not technically an official committee activity, so there will be no official record for this event, but any member who wishes to share any relevant statement, article, letter, or other item may do so by way of their personal office's communications methods. Members must also keep their microphones muted unless you're speaking, at which time you need to turn your video cameras and microphones on. For any member using a telephone and audio only, *6 will work to unmute and remute your phones. If anyone is experiencing difficulties during the briefing, please contact our committee's IT staff. You have their contact information, email, and phone that was sent out with the notice of the briefing. The clerk will now conduct a roll call, so we'll know who's on the call. The clerk, please call the roll.
Chairman Scott.
Present.
Mrs. Davis. Mr. Grijalva. Mr. Courtney. Ms. Fudge. Mr. Sablon. Ms. Wilson. Ms. Bonamici.
Present.
Mr. Takano. Ms. Adams. Mr. DeSaulnier. Mr. Norcross.
Present.
Ms. Jayapal. Mr. Morelli. Ms. Wild. Mr. Harder. Ms. McBath. Ms. Schreier. Ms. Underwood. Mrs. Hayes.
Present.
Ms. Shalala.
Present.
Ms. Webb.
Here.
Ms. Omar. Mr. Trone. Ms. Stevens. Mrs. Lee. Mrs. Trahan. Mr. Castro. Mrs. Fox. Mr. Rowe. Mr. Thompson. Mr. Wahlberg. Mr. Guthrie. Mr. Byrne. Mr. Grothman. Ms. Stefanik. Mr. Allen. Mr. Smucker. Mr. Banks. Mr. Walker. Mr. Comer. Mr. Klein. Mr. Fulcher. Mr. Watkins. Mr. Wright. Mr. Muser. Mr. Johnson. Mr. Keller. Mr. Murphy. Mr. Van Drew. Chairman Scott, this concludes the roll call.
Oops.
Kim Schreier's here.
Susan Davis. You hear me?
Lucy McBath is here.
Mr. Scott, you are muted.
Yep, I just noticed.
Okay.
Anyone else?
Did you get Susan Davis?
I did.
Yes.
Okay.
And you got Kim and Lucy also. Great, thank you.
Yep. Thank you. In a moment, you'll hear from our distinguished guests, and after our experts have finished their presentations, we'll open the floor for questions. And since this is an informal briefing, members will be recognized in the order in which they seek recognition, not by seniority. So please indicate if you have a question in the chat box. For those using a telephone with audio only, please have your staff indicate your interest in the chat box on your behalf. Today's briefing will last for an hour, so members should ask their questions succinctly and be considerate of other members who are waiting to ask questions. A chime will sound as a reminder when your time has expired. And we're going to have a 1-minute warning, Veronique. We'll have a 1-minute warning, which will
So we were going to go with the 5 minutes, straight up 5 minutes.
Okay, well, try not to use up the 5 minutes on your questions. And now I'll recognize myself for opening comments. Today we'll discuss several actions the Department of Labor has taken in the midst of the COVID-19 pandemic that are not in the best interest of workers saving for a secure retirement. To help make these critical choices, workers and families often look to financial advisors for guidance. In the same way that we might trust our doctor with our health care, workers should be able to trust their financial advisors with their hard-earned savings and feel confident that their interests are being put first. Unfortunately, the Department of Labor recently took steps that will erode retirement security for future retirees by exposing them to bad advice and undermining their protections. First, the department reinstated a weak, outdated standard that allows retirement advisors to sidestep their fiduciary duty and put their own interests above their clients' best interests. As my colleagues may recall, the Obama administration previously issued a rule to replace this deficient standard and prevent advisors from cheating their retirement clients. Yet instead of supporting these protections, Trump administration resurrected a loophole-ridden standard from 45 years ago. Compounding this problem, the department also proposed an additional rule that effectively bars clients from taking legal actions against fiduciary advisors who rip them off. Second, the department recently gave the green light to expose workers' retirement savings to private equity funds. This contradicts substantial research showing the potential gains from investing in private equity do not appear to outweigh the numerous risks, including high fees and lack of transparency. One study found private equity funds have failed to outperform public equity markets despite charging investors more in fees. And third, the department proposed a rule that needlessly discourages advisors from considering environmental, social, and governance factors, or ESG factors, in certain investment decisions. ESG funds are attracting more and more of the workers' 401k assets, and this is because workers want to invest in a way that reflects their values, whether fighting climate change or promoting health or labor standards without sacrificing returns. Plan beneficiaries understand this and seem to be appropriately balancing the risk when selecting investments for 401k plans. The department even acknowledges that as much in their proposed rule, saying that most fiduciaries are complying with the existing ESG guidance. Given this track record, the department has failed to provide a convincing, data-driven rationale for discouraging advisors from ESG funds. Instead, it looks like a solution in search of a problem. Simply put, the department is going out of its way to restrict investment options that the workers want, while simultaneously exposing them to greater risk from private equity funds and unethical advisors. In this time of great financial uncertainty, workers and their families should not have to worry about being cheated out of their hard-earned retirement savings. And so today we're joined by Aaron Shapiro and Barbara Roper to help us examine the Department of Labor's actions and discuss how Congress can ensure that workers get access to good faith retirement investment guidance. Mr. Shapiro is the Director of Policy Research for Morningstar. He is responsible for developing research reports on policy matters, coordinating official responses to regulatory proposals, and providing investor-focused comments on policy issues to clients and the press. He also chairs Morningstar's Public Policy Council. Ms. Roper is an expert on consumer and investor protection issues. She currently serves as the Director of Investor Protection at the Consumer Federation of America, where she has been employed since 1986. The CFA is an alliance of approximately 300 pro-consumer organizations. I thank you both for your time. We'll hear from our witnesses, and they have questions from the members, beginning with Mr. Shapiro.
Well, thank you so much, Chair. So I'm going to start by talking a little bit about the ESG proposal and then give a couple.
Excuse me, if people could make sure you.
Can everybody hear me okay? Okay, great. I'm going to start by talking about the ESG proposed rule and then just give a couple of comments on the fiduciary proposal as well before turning it over to Barbara. To talk more about the fiduciary aspect. So, some context here around ESG. More and more investors are putting their money into sustainable investments. Mutual funds that are focused on sustainability attracted $20 billion in flows last year. And that's not a huge number in terms of finance, but it was 4 times the flows that they attracted in 2018, and we expect that trend to continue. And these sustainable funds are generally informed by rigorous analysis of environmental, social, and governance metrics, or ESG. When we've done some surveys through our behavioral team, we find that investors from all demographic groups report interest in ESG investment choices. Somewhere around 75% of the U.S. adult population expressed at least moderate interest, and that interest is even higher among millennials. So this is a trend that's going to continue. So into this steps the Department of Labor. And just to really briefly summarize the rule, I think the most important thing is it would prohibit what they're calling ESG mandate funds. And this is not a term that's particularly well defined, from being default investment options. That's really important because that's where the money is, right? A lot of participants don't make a specific election. They sign up for their plan. They're defaulted into, maybe a target date fund that adjusts their asset allocation as they age. This has been one of the most successful things in retirement security over the last decade or so. And this rule would prohibit any kind of ESG approach in those qualified default investment alternatives. Huge problem. It would also put unique and increased scrutiny on ESG strategies outside of qualified default investment alternatives. That is just the sort of list of funds that a participant could choose to invest in. So it enhances that scrutiny in a way that is not true for any other style of investing. Just a few observations here. We think this is completely unneeded. ERISA sponsors, people sponsoring 401k plans, they know they have a fiduciary obligation to select funds that are going to perform well for their participants. There's no doubt about that. That's central to the role of the body of law that controls 401k plans. There's also no there. When we look at sustainable funds, they've outperformed conventional funds in the last 1, 3, and 5 year period, and that's net of fees. So the department makes kind of a big deal about fees in the proposed rule. I want to just get into a few specific reasons why the proposal would worsen outcomes for investors. It's very out of step with the best practices that asset managers are using to select securities in mutual funds. Instead of adding scrutiny to ESG considerations, we think that ESG risk analysis should be part of any prudent investment analysis. In fact, ESG factors really are fundamental to evaluating the likely long-term performance of an investment. Consider factors like climate change risk, negative social externalities, poor governance. Those are all deeply tied to a company's ability to generate cash flows and be successful over the long term. In addition to managing ESG risks, which we think every asset manager should do and every plan sponsor should consider as they're considering what investments are available to their workers, many participants want some kind of alternative that reflects their values. And that's really quite valuable as well. There's pretty good evidence right now that does not reduce returns. There are a lot of funds that have these kind of mandates that have done very well. We expect to continue to do well. And I think that aligning the investment options people have with their values can help bring more people into their 401k or encourage them to invest more. And so I think that is aligned with participants' interest. So just sort of a few concluding thoughts there. Again, evaluating long-term risks, including ESG risks, is fundamental to investing. The proposed rule kind of completely ignores that reality and the increasing mainstreaming of that idea in the investing and asset management community. The proposal puts up barriers that are unique, that don't exist for any other style of investing. And, in sort of an irony of this, we just don't think it's the government's job to dictate which investment strategies are likely to be successful and which ones aren't. And that's exactly what this proposal does. If there's time, I can just mention a few thoughts on the fiduciary rule, but I'm not sure how far, if I'm over. Okay. I think you're on mute.
The obnoxious chime will let you know when your time is up.
Wonderful. Okay, I wasn't sure there's some back and forth there. Okay, great. All right. So, just a few thoughts on the fiduciary rule here. We did some empirical analysis on the original fiduciary rule, and what we found was, and we essentially tried to update the Department of Labor's regulatory impact analysis. And what we found was that the 2016, well, just finish the sentence. 2016 rule really sped firms towards offering less conflicted, higher performing investment types. And we're worried about sort of a backsliding there, but I can speak to that more as we move along.
Thank you. Ms. Roper.
So thank you, Chairman Scott and members of the committee for holding this briefing on this important topic and for inviting me to participate. As Chairman Scott indicated in his opening remarks, the Department of Labor is engaged in a multi-pronged attack on Americans' retirement security. So first, the department is making the advice that workers and retirees receive about their retirement investments more conflicted and less trustworthy by weakening the ERISA fiduciary standard. So last month, the department issued a final rule reinstating the 1975 regulatory definition of fiduciary investment advice under ERISA. And because that definition includes gaping loopholes and hasn't been updated to reflect the changing roles of financial professionals, this one action ensures that much of the advice workers and retirees rely on regarding their retirement investments will not be held to a fiduciary standard. Of greatest concern, many rollover recommendations won't be held to a fiduciary standard, including the vast majority of recommendations to roll money out of a plan to purchase non-securities investments, such as annuities or Bitcoin or real estate or gold or other commodities. So precisely where the risks are greatest and the compensation-related conflicts are greatest and the sales practice standards are weakest, the ERISA fiduciary standard will not apply. So at the same time, the department proposed a broad new prohibited transaction exemption to allow investment advice fiduciaries to operate with extensive and potentially toxic conflicts of interest when the fiduciary standard does apply. So even when a firm can't use one of the loopholes in the definition to escape their fiduciary obligations entirely, they would still be held to a watered down, non-fiduciary standard that allows extensive room for conflicts of interest to influence their recommendations. And that's because the Department of Labor has based its new exemption on the Securities and Exchange Commission's recently implemented regulation best interest. But the SEC was explicit when it adopted Reg BI that it is not a fiduciary standard. And among other things, it does not actually require brokers to recommend the investments they reasonably believe are the best available option for the customer, as an investor would expect from a best interest standard. And it continues to allow a wide range of incentive practices that can and do encourage and reward recommendations that are profitable for the firm rather than those that are best for the investor. For example, it allows high-pressure production-based sales contests and quotas that have in the past been associated with inappropriate rollover recommendations. So Reg BI just simply is not an appropriate substitute for the high fiduciary standard under ERISA. It will leave financial firms free to siphon off billions of dollars a year out of the retirement accounts of workers and retirees to line their own pockets. Second, the department issued a new policy statement last month, making it retirement saving riskier by clearing the way for funds to include investment funds that contain exposure to private equity on their plan menus without appropriate safeguards. And there are a number of problems with this policy. They include the fact that it is based on a one-sided and inaccurate assessment of the potential benefits and risks of private equity investments. It allows the private equity exposure in target date funds, which are often used as default options in plans. And it allows the PE investments within collective investment trusts, which are less transparent than mutual funds and don't include the same restrictions on the percentage of assets that can be held in illiquid investments, such as private equity. Most importantly, it relies on employers as plan fiduciaries to have the sophistication to determine whether a fund's use of private equity is appropriate for their employees, but most employers, like most individuals, do not have that level of investment sophistication. And finally, as Aaron discussed, the department is making it harder to include funds on 401k plan menus that take environmental, social, and governance factors into account in their portfolio selection. In laying out the factors that plan fiduciaries have to consider when selecting ESG, the department's clear intent is to discourage their use. We think that will inevitably have the intended chilling effect on the inclusion of ESG funds in plan menus, despite the fact that research increasingly shows that ESG funds perform well and that considering ESG factors can significantly reduce a portfolio's volatility and vulnerability to systemic risks. Thank you.
Thank you. Now we'll go to questions from our members. Let's see. Do we have?
Congressman, Ms. Bonamici is first on the list.
Okay, Ms. Bonamici, thank you.
Thank you so much, Mr. Chairman, and thank you so much to the panelists. This is such an important discussion always, but particularly now during a pandemic where so many people are really living with so much uncertainty. Retirement security is even more important, and I really appreciate the information today. And regardless of the economic climate, financial advisors should act in the best interests of the people they're serving. I have a consumer protection background and have worked on consumer protection issues, and I would venture to guess or understand that most people think that their advisor is acting in their best interest. And I want to ask Ms. Roper, is there any way for workers or their families to distinguish which advisors are acting as a fiduciary and which are not?
So unfortunately, the actions that the SEC just took actually muddy the waters. So investors are now going to get disclosures, and they would get similar disclosures under the DOL proposal that will lead them to believe that everybody's providing essentially the same level of protections, is subject to essentially the same standard, when that is not the case. So, I mean, we have messages that we promote with investors to try to help them make sound decisions, but it's really hard when the basic disclosures they're going to get mislead them into expecting, meaningful fiduciary protections. Investors think a best interest standard is higher than a fiduciary standard. So when they're told that this broker has a best interest obligation, they're going to trust that. But it doesn't even mean best interest. It doesn't even mean you have to recommend the investments you think are best for the investor. And that is misleading, and it shouldn't have been adopted by the SEC, and it should not be incorporated by DOL.
Yeah, absolutely. And you talking about the SEC. Can we talk a little bit about the SEC's authority? Because I want some clarification on what is the SEC doing making rules under ERISA? Shouldn't that be done by the Department of Labor?
Yeah, good point. I mean, so technically, the Department of Labor is, of course, the agency that's acting in this space. They're proposing the rule. They're simply saying that they will interpret their best interest standard the same way the SEC interprets the best interest standard under Reg BI and the fiduciary duty under the Advisors Act and the NAIC's model standard, all of which are very different standards, by the way. So it's going to be bewildering.
Right, and that's the last thing we need for consumers. And just to clarify, I'm not suggesting that this Department of Labor would do any better job. It's just we need to be clear about who's responsible for which area of retirement security. And I just want to put a word in too about how frustrating it is what they're trying to do with the ESG funds and limiting those. That should be up to the worker, their family, and their advisor, not up to the Trump administration to say whether ESG funds should be and factors should be considered. And Mr. Shapiro, as you said, these actually should be considered with regard to long-term security of a company and of a fund. So it's very frustrating, and I hope we can do everything we can to block these changes by the Trump administration. And I appreciate the information today, and I yield back. Thank you, Mr. Chairman.
Thank you. Next, we have Levin, McBeth, and Takano. Mr. Levin.
Thank you so much, Mr. Chairman. It's great to see all of my colleagues and our esteemed guests. And this is such an important set of topics, really. Given the limited time, I want to focus on this ESG rules. So, Mr. Shapiro, who would you say stands to gain by this proposed rule, and explain why you think that? How would they stand to gain?
Well, I think it's pretty clear. Funds that are focused on social responsibility tend to tilt towards growth stocks, generally tech funds. They tilt away from energy. So to the extent that those considerations are not being considered inside the $7 trillion or so DC retirement plan marketplace, you would expect companies that are likely to be underweighted to benefit, and companies that might be overweighted to lose. I think, the really big issue here is around fixed income, because to the extent that companies that don't have a good sustainability plan, that are very vulnerable to either changes in regulation or just realities around climate change, are having a hard time raising capital, that's because professional investors don't think that they're going to be good for paying that back over time. And they may care a little bit less about their ability to raise capital through the equity markets, but certainly in the fixed income markets, they may need that. And I think that, that's they could be sort of the winners from this kind of policy. That said, there's a lot of other investment outside of that. There's a lot of signals that are being sent to sort of index funds that would incorporate this. So, I don't think it's that clear cut, but that would be that'd be the sort of obvious place I'd go.
And when you say energy, you mean really fossil fuels, don't you? There's, companies that work on solar, geothermal, wind, offshore wind, energy storage. That's not who you're talking about, right?
No, that's right. Absolutely. Yeah. I should have been probably a little bit more clear there. I'm in, sector analysis mode here, but yes.
Yeah, no, I hear you. I just want, for people watching, I just want to be really clear on that. So, another thing that you indicated was that research increasingly shows the benefits of ESG investments. And I wondered if you could expand on that. Talk to us about their returns, how they've done vis-a-vis conventional funds.
Yeah, so in general, conventional funds or ESG funds, sustainable funds outperform conventional funds. Let me just speak about 2019 here. 35% of sustainable funds were in the top quartile. Obviously, you'd only expect 25% to be in the top quartile, and another 30% were in the second quartile. So 65% of ESG funds or sustainable funds are in that top half. And that's an outperformance. You see the same kinds of trends when you look back over 3 years, over 5 years. So it's not to say every single sustainable fund outperforms, but they're more likely to than not. And I think that tells you something significant about the investment style. At least it tells you something about the last few years. These have been good investments by and large.
So, Mr. Shapiro, there's really no data-based way to say that this rule is about protecting investors and that these people who want to invest in ESG funds are disregarding their fiduciary duty. That doesn't seem credible just based on the facts, right?
I don't think it's credible, and I think that I don't know how else to put it, but bluntly, the regulatory impact analysis is is terrible. I mean, it really doesn't make the case. I think that's because the case isn't there to be made, but it essentially cites one survey of people abroad, not even in this country, who expect their sustainable funds to potentially perform worse. And that is not evidence. There's no evidence we can find that there has been a penalty to this kind of investment strategy. So I think it's pretty clear there's no solid basis for this rule at the moment.
Mr. Chairman, this is deeply troubling. We're in the middle of a pandemic. We are in a crisis of climate change. All the evidence suggests that people investing in a way that promotes the long-term sustainability of companies, their relationship with their stakeholders like their workers, their communities, and the environment actually does better from an investment point of view. It's terrible that the Trump administration would be trying to prevent people from investing in stocks and bonds that do particularly well just to favor certain interests in the economy. And we've got to do everything we can to stop it. Thanks for shining light on this. I yield back.
Thank you. We have Macbeth, Takano, and Shalala. Ms. Macbeth.
Thank you so much, Mr. Chairman, and thank you so much to our guests today, our experts. Really appreciate you coming before us and, reading the information that I got last night, and of course, continuing to read the data points and the key points. I'm very, very disturbed. The Department of Labor is actually reinstating this dated loophole. I myself is one who actually went from one organization business and transferred all of my 401k holdings, transferred everything over into another investment corporation. I wish I had known this. I wish I'd known this beforehand. But anyway, I just think that this is very troubling to me. And I think that the fact that the public is not even able to make comment on this loophole, I think is very distressing because people have, taken their hard-earned money that they've earned over the years and invested. But Ms. Roper, my question is for you. In your testimony, you suggested that most rollover recommendations would not be covered by the department's so-called fiduciary rule. Can you talk a little bit more about the scenarios when such recommendations would be covered? And are those institutions more the exception than the rule?
Right. So in order for something to be deemed fiduciary investment advice, it has to meet a 5-part test. And so it has to be advice about plan assets, it has to be personalized, it has to be offered on a regular basis, subject to a mutual agreement or recognition that the advice will form a primary basis for the investor's investment decision. So that test, advice provided on a regular basis, means that certain types of rollovers will be considered fiduciary advice. If an investment advisor, who's already a fiduciary under the securities laws, recommends a rollover into an advisory account where they're providing ongoing management, that will be subject to a fiduciary standard under ERISA as well. It essentially doubles up there. It's a little less clear whether rollover recommendations by brokers will be considered regular advice. Will their episodic recommendations be considered regular advice? I'm not certain that that's the case, but even there, at least Reg BI applies, right? But when there's a rollover that is viewed as a one-time recommendation, so when an insurance agent recommends that you pull your money out of the plan and buy an annuity, that will explicitly not be subject to the fiduciary standard. And we believe many of these kinds of rollovers to, the non-traditional types of non-securities investments, whether it's, help us, Bitcoin or art or gold, those aren't going to be viewed as regular advice either, so they will not be subject to the standard. So that's why I say when the risks are greatest, when the regulation is weakest, DOL is carving those transactions out of the standard.
Thank you.
Thank you. Mr. Chicano.
Thank you, Mr. Chairman. I so totally appreciate the your holding a briefing on this topic. I remember being in Congress as a freshman member or a second term member, and suddenly being barraged by Wall Street lobbyists, and I had no idea that this committee had jurisdiction on a topic that would draw so many interested parties from Wall Street. It was astounding to me that the Department of Labor, under, I think it was ERISA, had authority, and that the Fiduciary Rule was drawing such attention, and that there was the stakes were so high. And indeed, as I began to learn more about the topic and learn about the costs to everyday Americans who need to sort through all of the legalese and the terms that are thrown out, such as fiduciary. What is a fiduciary responsibility versus a best I forget the other term even. It's like eluding me. What is the term I hear?
So suitability was the old standard. Best interest now.
It's the best. So now it's now called best interest. Well, that sounds great. Best interest sounds wonderful, and it is misleading in the sense that it could lead the investor, the average investor who's trying to build a retirement. And we know that Americans in general have not built up retirement funds to have them live comfortably into retirement. And to have the rules, this was an example of the rules of the economy being rigged against ordinary people. The very thing that this president said that he wanted to do in his inaugural speech is being contradicted at this level. And I'm just so frustrated to get this out to the public. So, Mr. Roper, can you please explain why a private right of action is so important to retirement savers?
Absolutely. So,
Ms. Roper, excuse me, Ms.
No worries. Under the Obama era rule, the Department of Labor included provisions in their rule that specifically provided individual retirement account investors with remedies, right? So there's a contract requirement, and there are these warranties, and there's enforceability was built into that. And that's essential because the Department of Labor has no regulatory authority with regard to IRAs, and the IRS, which has regulatory authority, doesn't exercise it. So the real only recourse for investors, the only way to make firms take their compliance obligations seriously, and the only way for investors to protect their interests if they get victimized by conflicted advice is to allow them to pursue those claims individually. And the Department of Labor has said in issuing this new prohibited transaction explicitly that it does not create a private right of action, which means it will not be enforceable by IRA investors. It will not, therefore, be complied with by firms that are operating in that marketplace. And these are among the most vulnerable investors we have in our system. So
if a doctor gives you bad advice, a lawyer gives you bad advice, bad professional advice, the client has a recourse. If there's malpractice involved, but if a financial advisor, in this case, gives bad advice that accrues to their own interest instead of the client's interest, then you're telling me that there's no way in this circumstance for the investor, the small investor, to be able to have any kind of legal recourse against the harm that was done by that bad advice. Is that what you're saying?
that is exactly what I'm saying. I mean, there may be places like if it's a broker, you might be able to go into arbitration, right, and try to get recourse there. But if it's an insurance agent, you're out of luck. If it's one of these other non-regulated salespeople where the worst abuses occur, you're out of luck. So it's really stripping retirement savers of essential protections.
I remember how we went round and round over this issue about whether or not the financial advisor would have to make sure that a contract was signed, and that was a big issue about, like, they didn't want to have the client sign the contract. That was, to me, that was absurd to me. That the exact contract which would give the client the right to be able to hold the financial advisor accountable, like, not done. And this, to me, and in these hearings were taking place, this is a little understood, little attention was being paid, but so much consequence to millions and millions and millions of Americans. I thought President Obama really showed where his values were in standing up for Americans in an area where they didn't really most people didn't understand. The press was reporting, but not widely understood topic. So that, Mr. Chairman, I really am thankful that you've used your position to examine this topic more thoroughly, and I hope we do more of it. Frankly. I yield back. Thank you.
Thank you. Ms. Shalala.
Thank you. I'm trying to understand whether we're talking about individuals that go out and find their own financial advisor, or whether the company they work for provides them with a financial advisor. And in that case, what's the liability of the employer? I've spent most of my life in institutions that provided options for workers, and we were pretty careful about the responsibility of financial advisors. And I don't think we ever did it one-on-one. I think that we gave people information in groups and made sure that someone from the senior financial staff oversaw it at the same time. But does the employer have any responsibility in these cases?
So the employer is, of course, the fiduciary with regard to the selection of the options that are made available through the plan.
Right.
And if the employer looks to a financial professional for advice about that selection of plan options, the advisor they turn to may or may not be a fiduciary. One of the things that President Obama tried to do in his rule was ensure that at small plans would get the same fiduciary protections as individuals, precisely because many employers simply are not well equipped to make those selections. Then, in many cases, this is going to apply to individuals who are either on their own getting advice about investments that include their 401k plan investments or investments in IRAs. And I am sure there's an answer to your question about the ERISA obligations of employers when they provide access to advice through the workplace. My background is on securities. I don't know the answer to that question. I know who knows the answer and would be happy to get it to you.
Shalala, do you have other questions?
No, that,
Okay.
That's the context in which, well, let me ask another question then. I spent most of my life in universities in which the choice was TIAA CREF. And you basically said what percentage of your money you wanted in CREF and what percentage of your money you wanted in TIAA, with very little advice, by the way, usually at the beginning of your career. Is that covered by this rule?
So if you went out and asked someone for advice about what you should do, that would be either covered or not covered by this rule. In other words, if it was a one-time engagement and you asked for advice on a one-time basis, that's not advice on a regular basis and would not trigger the fiduciary duty. If you ask it of someone with whom you have an ongoing relationship, advisory relationship, then it would be covered by the rule. But I think your point that workers are making these decisions that will determine their ability to afford an independent and dignified retirement without a high level of financial sophistication And the least we ought to be able to do is ensure that when they turn to a financial professional to help them with those decisions, they get advice that truly puts their interests first.
I agree. Thank you, Mr. Chairman. I yield back.
Thank you. Let me ask a couple of questions. Mr. Shapiro, you had started on the fiduciary rule when your time ran out, and you had mentioned what it was like when the Obama rule was temporarily in effect, and there was a change of behavior, and there's been that.
I'm sorry, that it just broke up for a half a second there.
Okay, you had the Obama rule. You had the Obama rule in effect for a little while, and you suggested, I think, that there's a change of behavior, and since the rule has been set aside, there's been some regression. Can you say what happened and finish your thought on the fiduciary rule?
Yeah, absolutely. So what we observed was when the rule was finalized in 2016, even before it went into effect, but firms were rapidly preparing for it, what we saw was a sharp decline in fund flows, that is new assets going into funds that were particularly conflicted. So we can track all these different kinds of funds. We have a pretty good way of identifying which ones have various conflicts. Those funds with unusually high levels of conflicts had also been associated with worse returns, which makes a certain kind of intuitive sense. They kind of had to pay for distribution, right? They sort of weren't sold on merit. And so we saw a decline there. What we're seeing now is at least some increase in flows into funds with revenue sharing arrangements and other kinds of third-party payments to the folks selling the funds. And that's disheartening. We had hoped that some of the provisions in regulation best interest might be interpreted by the commission to require more scrutiny on these arrangements. We haven't seen that. And so we're very concerned about the DOL sort of lifting these protections because they don't seem to be causing a change in fund flows or making broker-dealers think twice about offering funds where they have a real conflict of interest. I would observe that we do continue to see asset-weighted fees fall, and that's a good thing. So investors are continuing to pay less on sort of across all investors. But yeah, it's troubling, and it was sort of very exciting for a moment where you saw these reforms rapidly happening, and that's all kind of been paused.
You said asset-based fees. How would fees be based if it's not on assets?
Oh, I just mean asset weighted. So if you take the straight average of all of the mutual funds out there, the fees have come down a little bit. But if you look at an asset weighted fee, which accounts for the fact that a lot of money is now flowing into funds with much lower fees than higher fees, sort of the total amount of money ordinary investors are spending to get advice on mutual funds has been declining, and it declines a few basis points every year. So that trend has continued, which is good.
And what has happened to load funds?
Yeah, I mean, look,
which used to be pretty routine. Are they surviving today?
They don't seem to be, and I think that's also probably good news. So these are, of course, funds where there's a front-end load the investor paid, it's kicked back or sent back, we use nicer language, as part of the structure for a commission. What we're seeing instead are revenue sharing funds. Now, these are more opaque because with a load sharing fund or a load fund, I can go and look as an investor and I say, okay, this fund charges me 5 3/4 up front, and I know that. Whereas revenue sharing comes out of the management fee. And so it looks like a fee that is going to what the manager is supposed to be doing, buying and selling securities on my behalf. And instead, it's being paid to partners. And there's no good way to track that. We know it exists. So we can flag funds where it exists and where it doesn't, but we don't know, how pernicious the conflict is because there's limited disclosure. And not to get really in the weeds here, but I don't want to celebrate too much about kind of the rapid decline of the load fund or the A share. When you start looking at some of these dual registered arrangements, where there's a firm that has both registered investment advisors and broker dealers, we think a lot of the conflicts on the broker dealer side can spill over into the registered investment side. That's a problem because the investor there has selected somebody that they think of as a registered investment advisor, a fiduciary under the Advisors Act, and the firm-wide conflicts. Maybe the rep is fine, but the firm-wide conflicts in terms of which funds are available, which ones are popping up on that rep's software platform could be influenced by those revenue sharing arrangements. And we think this is likely to be a growing problem that will demand some scrutiny.
Yeah, was that cured in the Obama rule?
Yes, the Obama rule would have completely cured that. The warranty requirement and the best interest contract exemption said you can't do that. And so what was happening was there was a creation of what lots of folks called clean shares and what we called in a Morningstar fashion unbundled share classes that, you could just see it all getting kind of spun up so that there would be more share classes that simply eschewed these conflicts. So they didn't have to manage them. They wouldn't have them and it wouldn't be an issue.
Well, let me ask you and Ms. Roper whether or not going forward our strategy ought to be relying on a strategy of rules and regulations, or whether we ought to do this by statute.
Do you want me to jump in on that, Aaron?
Yeah, whatever.
Okay, so I would say, in theory, you don't need legislation to solve this problem. Everything that the Obama administration tried to do in 2016 fits well within what's permitted under ERISA, and the rule was vacated based on one court decision that was an outlier, that was wrong on the facts and wrong on the law. And if they're in a different administration, if they had continued to defend the rule, we think there's a good reason to believe it would have survived, as it did in every other court challenge it faced. But the fact that the rule was vacated creates this sort of ambiguity about whether, what the department can do, and in particular about this definition, because don't forget, that was the point of the Obama administration rule, was to close those loopholes, right? That's the reason you got the best interest contract exemption, was because they were bringing everybody inside the tent. And so I do think legislation could play a useful role in just making it clear that you want all rollovers covered, for example, that you want all of the services that investors reasonably rely on as investment advice to be subject to this standard. So I do think there's a role that legislation could be played there to help us get out of this sort of ping pong of legal challenges that we seem to be engaged in now.
Well, you mentioned the rollover. For an average worker, just a middle class worker, $50,000 a year, retiring, how much money are we talking about on a rollover?
So I'm not sure there's the single answer to that. If they're rolled over into an annuity, so that wouldn't be covered by the fiduciary standard, you could be looking at, depending on the type of annuity, a 7% commission. It might have.
How much money are people amassing to be rolled over when they retire?
Oh, do you have an answer to that, Aaron?
Yeah, when you look at the Employee Benefit Research Institute simulations, and you'll find that it's not uncommon to have $250,000 to $500,000 saved up, right? If you've been steadily saving, it depends, on the worker, how much coverage they had, how generous the matches were, but we're talking, I would say, real money here. This isn't a couple $1,000s at the end of a career. Right,
and collectively, it's a huge pot of money, right? Which is why everybody wants access to it. It's why private equity is coming for 401ks. It's a trillions of dollars collectively.
Thank you. Do the other members have questions? If not, let me ask a question about private equity. We haven't had much about that. Why are these in retirement funds anyway? They seem totally inappropriate for somebody's retirement fund. I can see on the side where you're, throwing the dice and hoping for the best. But in your retirement fund, it just seems like such an inappropriate investment.
So I couldn't agree more. The genesis for this idea, I mean, aside from the fact that the private equity industry has been trying to get its hands on this pot of money for a long time because they see their traditional pension market for their products shrinking, the genesis for this idea really seems to again be SEC Chairman Jay Clayton, who gave a number of speeches in which he said, I don't see why ordinary workers shouldn't have access to the same kind of investments that they get through their pension funds. I'm like, I don't know, maybe because the ordinary investor isn't a chartered financial analyst who's capable of assessing a product that is illiquid and opaque and complex and risky. You know, maybe there's a reason we've made the decision not to include private equity in these investments. And to be clear, it is not allowed as a direct investment in retirement funds yet. Let's leave that for a second Trump administration if that should arrive. But the provisions in the rule that are designed to sort of put safeguards around this, or it's not a rule, it's an opinion, aren't remotely accessed. And just think about the fact that it would allow private equity exposure in default investments while it's not allowing ESG exposure in default investments. And I think you start to get at what's motivating these actions. And it's political, it's not policy.
Ms. Roper, you mentioned a word that caught my attention. It was contests. In terms of, can you say what's going on there?
Right. So under Reg DI, and by extension under the department's proposed new exemption, there are certain limitations on contests. So if you have a contest that is high pressure, time limited, and product specific, it would be presented under the rules. But if it's...
What is a contest?
A contest means you get trips or other non-cash awards or the perks that go with being part of the chairman's circle for meeting a certain, you know, beating your other competitive sales reps in terms of the volume that you sell. Either of a
total volume or specific products that may or may not be appropriate.
So absolutely permitted still are the what we call production-based contests. So if it's based on total volume. And the problem there is that we've seen as the Massachusetts had the action against Scottrade, you see these production-based contests that are very high pressure that are specifically encourage inappropriate rollover recommendations because they're based on your ability to gather assets. And the quickest way to gather assets is to move them out of the retirement plan and into an IRA at your firm. So those would be absolutely permitted. And then for these other, so if it's product specific, well, it can be product specific as long as it's not time limited, right? I mean, firms are going to have to tweak their contests, but they're not going to have to eliminate their contests, and they're still going to be incenting their sales reps to give the recommendations that are profitable for them instead of the recommendations that are best for the investor.
I know the TSP sends out an occasional warning about people taking their money out of the TSP, which has a fees that are a small percentage of what's the general market charges, because they have such a volume. Because if you take it out of there where the returns are fairly good and stick it somewhere else, you're going to be paying fees that are significantly higher. And I think what you're saying is if somebody in one of these firms can talk you into taking that nice TSP, the federal 401k plan essentially, and sticking it into one of their firms, they get paid extra and you get charged extra.
That's exactly right. And the TSP has the lowest expenses, right? I mean, it's the gold standard on that front. But as a general matter, workplace retirement plans have lower expenses than you typically get outside of, if you're investing in an IRA outside of a workplace retirement plan. And they have other benefits that come from the protections of ERISA. Those don't always function as well as they should, particularly in the small plan market. But yes, you are being lured to take your money out of this lower cost, safer environment because it is profitable for the firm who wants to get the profits from managing your money.
The other members have questions. Let me ask you about everybody selling S&P 500 funds, which are essentially the same fund. The only difference is how much you charge. Some are charging almost nothing. I guess they make the money in the transactions that aren't part of a management fee. And others are charging as much as 1%, which over 20 years is 20%. How can a fiduciary sell anything other than a virtual no-fee S&P 500 fund? Because you know what the returns are going to be. They're going to be the S&P 500 returns.
Yeah, I mean, so, and I'll let Aaron get in as well, but we actually did some research analysis a few years back using data provided by Morningstar to look at the differences in expenses to investors for S&P 500 index funds once you took out the compensation to the broker. So 12B1 fees, commissions, we ignored that. We just looked at their base expense ratios, and what you found is that the expense ratios were significantly higher on the broker sold funds even after you took out the compensation for the broker, because that market doesn't work. And for something as basic as an S&P 500 index fund, you would think that a best interest standard would say you've got to sell the cheapest product. There's no added benefit to that higher that you get in return for paying that higher expense. But the SEC has gone out of its way to say that best doesn't necessarily mean lowest cost. And yes, you have to consider costs, but I don't know how you have to consider cost. And if you can come up with some rationalization, it's all going to be good.
I mean, the only thing I would add to that is you do see that most of the higher expense conventional index funds, right, as opposed to indexes that are tracking something more bespoke, the money is all flowing to the lower cost funds. And there might be some compelling reason somebody in a slightly higher cost fund might leave it there, particularly if it's in a taxable brokerage where they don't want to incur a tax event by selling. So, there may be some of that. But yeah, I mean, this is the case. These things have become commodities for the most part. There are some differences between how indexes sample there's other sort of subtleties that are different between them. Some of them are also making some money off of securities lending, and you may or may not want that. But basically these are commodities that can get away with charging a low fee, and that's where people should be if they're trying to get that strategy return.
Could I point out that in a sense, we've created a disincentive for brokers to sell S&P 500 index funds or other index funds, because it's harder for them to justify selling the higher cost variety. So even when that is a very good option for the investor, they're going to steer clear, which is one reason why you see these costs migrating so low, is because they're doing it through the really low cost providers. It's the direct investors, who aren't going through a salesperson or who are going through retirement plans, who are driving that drop in costs.
Okay. The other questions? If not, I want to thank both of you for participating today. This is really great information, and as both of you have indicated, this could be the biggest financial decision people are making, more than buying a house. And this is a prime opportunity for some unscrupulous dealers to just take advantage. Most people in this situation, all they knew is just to meticulously set aside something every month. If the employer set up a good default target date fund or something like that, there would be a reasonable investment. All they did is set aside a reasonable amount. Now they're looking up ready to retire with $500,000, and haven't had five figures to look at. Now they're looking at six. And the idea that you would not require a fiduciary responsibility, that the investors, the workers' best interest just seems shocking. So I want to thank you both for your participation today. And we're going to do what we can. We've been fighting for a fiduciary rule for a long time, and we'll continue to fight these private equity, as you pointed out. The idea that you would include private equity and not include better returns that you get in the ESG funds just defies data, defies logic.
So thank you, Chairman Scott. And can I just say, you have been a hero on this issue. You have been a real leader, and we greatly appreciate all that you've done to try to support the strong rule and what you're doing now to try and draw attention to this issue.
Good. Thank you. And thank you both.
Thank you so much for the invitation to speak to you.
Thank you. Is there anything else? Thank you very much. This concludes the briefing.